Welcome to the ProTicker Deep Dive.
Glad to be here.
So, today we are looking at a market that is just caught in the middle of a massive, really unprecedented tug of war.
Yeah, unprecedented is the right word.
Right. And our mission today is to navigate this explosive, high-stakes world of AI infrastructure and semiconductor markets as we stand here in early March 2026.
And it is volatile right now.
It is.
Yeah.
Because on one side of this equation, you have a corporate spending cycle on artificial intelligence that, frankly, defies historical comparison. It's driven by these mind-blowing technological leaps.
Like NVIDIA's Vera Rubin.
Exactly. Vera Rubin and AMD's MI350 architectures. But pulling violently on the other end of that rope is this intense macroeconomic anxiety.
And the geopolitical landscape, which is radically shifting.
Radically. We're talking about strict new U.S. export thresholds, immediate tariffs, complex revenue-sharing agreements, and the explosive, arguably forced maturation of China's domestic chip market.
It's a lot for anyone to process.
It is. For anyone, allocating capital or managing supply chains in this sector right now, the variables have never been more complex or carried higher stakes.
Never.
Okay, let's unpack this. Set in the scene, we really have to look at the severe disconnect between the underlying fundamentals of these tech giants and the actual price action we've seen on the board.
Right. The tape is telling a very different story than the balance sheets.
Yeah. The tech sector has endured a notably rough start to 2026. Despite printing numbers that would have seemed completely impossible just 36 months ago, the AI darlings have aggressively pulled back.
Pulled back hard.
NVIDIA is sitting roughly 14% off its peak, trading right around that $182 level.
And Micron is actively consolidating below its recent high of $455.
So the immediate question for you as an observer or a participant in this market is why? Why are these valuations compressing while the compute demand curve is still just going parabolic?
The answer to that lies entirely in the macroeconomic data.
The macro.
Yeah, the macro. It's currently acting as the ultimate governor on multiple expansion in the entire semiconductor space. You have to decouple the underlying silicon technology from the actual capital expenditure mechanisms that fund it.
Right, because these aren't retail products.
Exactly. These semiconductor heavyweights are bound to the procurement schedules of the hyperscalers.
Microsoft, Amazon, Google, Meta.
Those exact four. When you are looking at capital expenditure decisions measured in the tens of billions of dollars per quarter, those allocations are fundamentally tethered to the projected health of the broader consumer and enterprise economy.
They don't spend in a vacuum.
They don't. The hyperscalers fund these massive data center build-outs based on forward projections of cloud consumption. So if the broader labor market begins to show structural weakness...
The immediate secondary effect is a rise in recessionary posturing.
Yes, among enterprise executives. When that recession fear sets in, corporate IT budgets are the first targets for optimization.
They always are. It's the easiest lever to pull.
Right. So the enterprise slows down its cloud migration or limits its compute usage. Then the hyperscaler sees a plateau in forward revenue, and eventually they taper their order flow for the next generation clusters from NVIDIA or AMD.
And the market is highly efficient.
Highly. It prices in that sequence of events quarters before a single server order is actually canceled.
Which brings us to the acute real-time context of this specific week in March 2026.
Yeah, this is a big week.
The entire sector is basically hanging on a crucial slate of economic indicators. Primarily the non-farm payrolls print dropping this Friday.
The NFP is everything right now.
The consensus heading into this NFT report expects roughly 170,000 jobs added.
Right.
When you contextualize that against the 256,000 print we saw back in January, you are looking at a forecasted deceleration that leaves, honestly, very little room for error.
The market is walking a tightrope here.
Yeah. If the print comes in below 130,000, you are looking at a scenario where growth models have to be rapidly revised downward.
Because a miss of that magnitude confirms the sputtering economic engine thesis.
Triggering a broad sell-off. The market attempts to front-run the anticipated tightening of enterprise tech spending.
But on the other hand, if we see a substantial beat...
Like anything pushing past 200,000.
Right, anything over 200K.
Yep.
The immediate reaction is typically a relief rally for the underlying business fundamentals.
Because the economy's holding up.
Exactly. However, that beat introduces a secondary headwind.
The Fed.
The Fed. A persistently robust labor market effectively takes near-term Federal Reserve rate cuts completely off the table.
And when the risk-free rate stays elevated, The discount rate applied to the future cash flows of these high-growth tech companies remains high.
Which naturally suppresses their valuation multiples. It doesn't matter how many GPUs they are shipping if the discount rate is working against them.
Right, and the NFP is just one piece of the puzzle here.
Yeah, you also have to cross-reference the labor data with the ISM Services PMI.
Which is currently the pulse for approximately 70% of U.S. GDP.
It's massive, and the expectation there is a slight easing, going from 54.1 down to 52.8.
But the demarcation line you really must watch is 50.
Exactly 50. A reading below 50 signals an outright contraction in the services sector.
Which would serve as a definitive red flag for corporate tech procurement.
Absolutely. And when you combine that PMI trajectory with the JOLTS data and weekly jobless claims, the picture becomes incredibly highly sensitized.
The psychological threshold on jobless claims right now is 240,000.
Yeah, 240K is the magic number. If claims spike above that level, it spooks algorithmic and institutional traders alike.
It signals that corporate America is freezing its willingness to invest in growth, labor, and subsequently, infrastructure.
And this macroeconomic sensitivity creates highly divergent risk profiles across the semiconductor landscape, which is why tracking the beta of these specific assets is vital for your portfolio risk management.
Let's talk about beta. It effectively quantifies the volatility of a specific stock relative to the broader market.
Right. So when you look at NVIDIA, it currently carries a beta of just 0.35.
That is low.
Very low. It moves roughly a third as much as the broader index on any given macroeconomic swing.
That 0.35 beta makes NVIDIA an incredibly steady play within a notoriously volatile sector.
It implies the market views NVIDIA's revenue stream as highly insulated from typical economic shocks.
They're essentially treating their compute infrastructure as a non-discretionary utility at this point.
Like water or electricity, but Micron, conversely, is operating in a totally different volatility regime.
Micron has a beta of 2.28.
2.28. So if the broader market takes a 2% hit on a weak ISM print or a jobless claim spike,
You can model Micron to fall anywhere from 4.5% to near 7% strictly on macro beta.
completely devoid of any internal operational missteps, they could execute perfectly and still drop 7%.
That asymmetry dictates your position sizing. Holding Micron gives you extreme torque to the upside when the macro environment is accommodating.
But it subjects you to severe leverage drawdowns when the economic data misses expectations.
Okay, here's where it gets really interesting. Because when you isolate the company's specific fundamentals from the macro noise, the underlying reality of the heavyweight hardware providers is staggering.
Staggering is the word. Look at the structural moat NVIDIA has constructed.
Their Q4 fiscal 2026 results delivered $68.1 billion in total revenue.
Marking a 73% year-over-year expansion.
At that scale, 73% is just, it's hard to comprehend. Digging into the segment breakdown, data center revenue accounted for $62.3 billion of that total.
Driving a full-year revenue figure of $215.9 billion?
These figures force a complete recalibration of the total addressable market for compute.
They do. But the critical factor for you to understand here is that NVIDIA's dominance is not strictly derived from superior silicon engineering.
Right. Their competitive moat is deeply entrenched in the CUDA software platform.
CUDA has been systematically refined for over a generation, and it currently operates with an install base of over 5 million developers globally.
5 million. NVIDIA recognized early on that if you control the software layer that developers use to write AI applications, you dictate the hardware they must procure to run it.
It's the ultimate lock-in. The switching costs associated with moving away from CUDA are prohibitive for most organizations.
You aren't just swapping out a server rack.
No, you are abandoning a highly optimized, mature software ecosystem, and you're forcing your entire engineering department to rewrite their code base for a new, potentially less stable architecture.
And NVIDIA leverages that lock-in to maintain a relentless product cadence. We are seeing Blackwell currently shipping in massive volumes, addressing the immediate compute deficit in the market.
Yet, even as hyperscalers integrate Blackwell,
NVIDIA is already sampling Vera Rubin,
the successor architecture,
already sampling it with key Tier 1 customers.
this strategy intentionally accelerates the hardware depreciation cycle. It forces buyers to perpetually upgrade just to maintain competitive latency and throughput metrics.
And the financial reflection of this dominance is an operating margin sitting around 75%.
75% hardware margins. It's unheard of.
And to quell arguments that this is merely a cyclical peak built on overordering, You have to look at their order book.
They have established roughly $500 billion in direct visibility for the Blackwell and Rubin architectures.
Stretching linearly through the end of 2026.
That level of visibility and that margin profile naturally attracts the most aggressive, well-capitalized competition on the planet.
Cue AMD.
Exactly. AMD is executing a massive counteroffensive specifically designed to exploit the very few vulnerabilities in NVIDIA's armor.
AMD's launch of the Instinct MI350 GPU represents a fundamental leap in hardware design.
They are leveraging the N3P process node and their proprietary CDNA 4.0 architecture.
But the true differentiating factor is the memory configuration.
Memory is everything here. The MI350 is outfitted with up to 288 gigabytes of HBM3E memory,
Delivering a memory bandwidth of 8 terabytes per second.
In the realm of large language models, memory bandwidth is frequently the primary bottleneck. It dictates how fast the processor can actually fetch data to perform calculations.
By maximizing the on-package memory, AMD allows the MI350 to hold significantly larger model weights directly next to the compute cores,
And that architectural decision directly supports AMD's primary marketing claim.
which is that the MI350 delivers 2.2 times the performance of NVIDIA's Blackwell B200.
Specifically for inference processing workloads.
That is an incredibly targeted metric, 2.2 times faster for inference.
But hardware parity, or even superiority, is insufficient without a viable strategy to bypass CUDA.
Right, because of that moat we talked about.
Exactly. So AMD is leaning entirely into an open-source commoditization strategy to neutralize the software moat.
They've rolled out ROCm7, which benchmarks demonstrate a threefold performance improvement over its predecessor.
However, the true catalyst is their integration with OpenAI software stacks, predominantly OpenAI's Triton.
Triton is fascinating. It serves as an abstraction layer. It allows developers to write code that is hardware agnostic.
If a developer codes in Triton, that model can execute on NVIDIA silicon or AMD silicon with highly comparable efficiency.
If the broader machine learning community standardized on Triton over the next 12 months,
It would effectively commoditize the software layer, reducing the competitive landscape back to raw hardware throughput and total cost of ownership.
a battlefield where the MI350 is highly formidable.
Highly. But AMD recognizes that competing on raw silicon and software is only 2/3 of the equation.
The deployment model for data centers has fundamentally shifted.
Hyperscalers no longer want to buy discrete chips and figure out the networking, power delivery, and liquid cooling themselves.
I want fully integrated, rack-scale solutions delivered to their facilities, ready to be plugged into the main power bus.
Plug and play at the warehouse scale. This operational reality is what drove AMD's highly strategic $3.2 billion acquisition of ZT Systems.
The financial engineering of this deal is crucial.
Oh, it's brilliant. AMD acquired the entire entity to secure the high-value system design and rack-scale intellectual property.
Enabling them to design complete, turnkey AI clusters that rival NVIDIA's DGX systems.
But almost immediately, AMD spun off and sold the capital-intensive physical manufacturing arm of ZT Systems.
Sold it to Sanmina for $2.4 billion.
Right, so they effectively acquired world-class, rack-scale design capabilities for a net outlay of $800 million.
While protecting their balance sheet from the low-margin realities of physical server assembly.
It's an elegant capital allocation maneuver. It positions AMD to compete at the cluster level rather than just the chip level.
But all of these architectural advancements from both NVIDIA and AMD are entirely reliant on the availability of the high-octane fuel that drives them.
Advanced memory.
Advanced memory, high bandwidth memory, or HBM, is physically distinct from standard DRAM.
It involves stacking memory die vertically and integrating them onto the same silicon interposer as the GPU.
The engineering tolerances required to achieve the necessary yield rates are brutal.
Brutal, which creates a massive barrier to entry. Currently, the global supply of HBM is tightly consolidated among just 3 entities.
Samsung, SK Hynix, and Micron.
And Micron has engineered an incredibly aggressive position within this oligopoly.
Looking at their current fiscal year, they are projecting earnings growth of 307.6%.
307.6%. That multiple expansion is driven by a structural supply-demand imbalance, but Micron is compounding that advantage through rapid product iteration.
They recently introduced a 256 gigabyte LPDRAM SOCAMM2 module.
And this fundamentally alters the power calculus for data center operators.
This new architecture consumes one-third of the power required by standard alternatives.
When you are modeling a data center deployment featuring 100,000 GPUs, the limiting factor is no longer the capital to buy the chips.
No, it's the physical capacity of the regional power grid to supply the facility.
And the cooling infrastructure required to prevent the hardware from melting into slag?
A memory module that slashes power consumption by 66% is a critical operational advantage.
It allows operators to increase compute density within existing power envelopes.
However, you have to price in the cyclicality inherent to the memory market. The 307.6% growth projection is a function of the current scarcity.
Memory is fundamentally a commodity product. The pricing power Micron currently wields will face pressure as Samsung and SK Hynix aggressively optimize their own HBM fabrication yields.
The capital cycle in memory is historically vicious.
Fabs overbuild capacity to capture peak pricing. The market tips into oversupply, spot prices crash, and margins collapse.
Given Micron's 2.28 beta, any indication that the HBM market is transitioning from supply-constrained to equilibrium will be aggressively front-run by institutional sellers.
You have to be incredibly nimble, and the broader ecosystem surrounding these heavyweights is equally critical to monitor.
The picks and shovels of this infrastructure build-out capture massive value with slightly different risk profiles.
Look at TSMC. They remain the single point of failure and success for the global transition.
Currently deriving 58% of its total revenue strictly from high-performance computing fabrication.
58%. And Broadcom is quietly dominating the interconnect layer.
Providing the Ethernet AI networking switches and custom silicon design services that allow tens of thousands of individual GPUs to function coherently as a single supercomputer.
Conversely, you have Intel, operating under Pat Gelsinger, executing a highly capital-intensive contrarian strategy.
Rather than leaning exclusively into the fabless model utilized by NVIDIA and AMD.
Intel is leveraging massive sovereign subsidies to build domestic foundry capacity, attempting to rival TSMC directly in advanced packaging and fabrication.
It is a long-tail play, banking on the global desire for localized supply chains.
It's risky, but if it pays off, it's a massive win.
Now, all of these individual corporate strategies are currently being evaluated against a massive structural transition occurring within the AI market itself.
The pivot from the training phase to the inference phase.
The last 3 years were defined by the brute force training of massive foundational models.
Training workloads demand maximum, uninterrupted computational throughput.
An environment where NVIDIA's massive power-hungry clusters hold an undisputed advantage.
However, as models like GPT-4 or Claude reach maturation, the economic value shifts toward deploying those models to generate outputs for end users.
The inference phase.
Right, and inference workloads prioritize completely different metrics: low latency, high efficiency, and minimal power consumption per query.
This structural pivot inherently favors hardware architectures optimized for speed and efficiency over raw brute force power.
Which perfectly contextualizes why AMD is so aggressively marketing the MI350's 2.2x inference advantage.
The companies that dominate the training phase are not guaranteed to maintain their market share, as the global compute demand transitions heavily toward inference over the course of 2026 and 2027.
Exactly. What's fascinating here is that every technical specification, every capital expenditure model, and every product roadmap we have discussed is suddenly subject to severe geopolitical interference.
The underlying physics of the semiconductors are no longer the sole variable. The regulatory environment has become the primary bottleneck.
On January 15, 2026, the U.S. Bureau of Industry and Security, the BIS, fundamentally rewrote the rules governing the export of advanced AI infrastructure to China and Macau.
We have moved away from the blunt instrument of a blanket presumption of denial.
The BIS has transitioned the industry to a highly scrutinized case-by-case licensing framework, but the technical thresholds established for license eligibility are aggressively restrictive.
The BIS defined specific performance ceilings that manufacturers must adhere to.
To even apply for an export license, the silicon must have a total processing performance, or TPP, strictly below 21,000.
Coupled with a DRAM bandwidth capped at 6,500 gigabytes per second.
And these are not arbitrary figures.
No, they were meticulously calculated to encompass the specific, slightly decelerated architectures that NVIDIA and AMD engineered precisely for the Chinese market.
Specifically targeting the NVIDIA H200 and AMD's MI325X and the new MI308 variants.
By capping the TPP and memory bandwidth, regulators are ensuring that the hardware entering the Chinese market cannot effectively be clustered to rival the massive training runs occurring within U.S. borders.
Right. The BIS export controls are functioning in tandem with unprecedented economic maneuvers from the Trump administration.
Utilizing a Section 232 proclamation, a sweeping 25% tariff was immediately levied on the importation of these advanced chips.
Explicitly penalizing any silicon not designated for domestic U.S. programs.
However, the mechanism that fundamentally altered the global market is the accompanying quid pro quo revenue-sharing agreement.
The administration provided a highly conditional pathway for export. Manufacturers can secure the case-by-case licenses to ship these capped chips to approved Chinese entities.
But only if they remit a 15% revenue-sharing fee directly to the United States government.
A 15% top-line fee. The logistical friction created by this framework is immense. The compliance checklist required to secure a single export license is a labyrinth.
Let's walk through it. First, the manufacturer must definitively prove that the exact chip model intended for export is currently commercially available and actively being sold within the United States.
This mandate completely eliminates the viability of designing bespoke, China-only silicon architectures designed to game the TPP thresholds.
Second, the company must provide logistical guarantees that fulfilling the Chinese export order will not introduce any delay or supply chain friction for U.S.-based customers.
Domestic infrastructure buildouts are prioritized by law.
The third hurdle is a strict volume control mechanism. The BIS mandates that total shipments of a specific architecture to China are hard capped at 50% of the volume that the manufacturer successfully deploys within the U.S. market.
If you cannot sell it domestically, you cannot scale it internationally.
This artificially anchors the growth rate of Chinese AI infrastructure to the procurement appetite of the American hyperscalers.
And finally, before any hardware is authorized for physical export, it must undergo mandatory empirical testing by an independent U.S.-headquartered laboratory.
To certify that the silicon's processing capabilities do not exceed the 21,000 TPP and 6,500 GHz bandwidth limitations.
And the regulatory bodies also recognize that physical silicon embargoes are highly porous if foreign entities can simply lease the necessary compute power dynamically.
Right. Consequently, they aggressively close the cloud compute loophole.
The updated regulations impose severe Know Your Customer or KYC requirements on all infrastructure as a service providers.
An American cloud operator cannot simply lease instances of their H200 or MI350 clusters blindly.
They bear the legal burden of continuously verifying and guaranteeing that restricted foreign entities are not remotely executing workloads on advanced AI infrastructure via their cloud platforms.
The compliance overhead and monitoring software required to enforce this at the network level is a massive operational tax on the IaaS providers.
The divergence in how the two primary hardware vendors are navigating this bureaucratic gauntlet is striking.
AMD appears to have successfully decoded the compliance requirements, successfully securing export licenses for a portion of their China-specific MI308 allocation.
They are actively navigating the independent testing and volume cap requirements and moving hardware across the border.
NVIDIA, conversely, has encountered severe friction. The current data indicates that NVIDIA has been entirely gridlocked.
Unable to facilitate a single authorized shipment of the H200 to Chinese buyers in the nearly 3 months since the BIS framework was implemented.
So what does this all mean for the financial dynamics of the actual transactions once they clear the regulatory hurdles?
The central question regarding the 15% U.S. government revenue sharing fee is margin absorption.
Do NVIDIA and AMD accept a margin compression to maintain price parity in the region, or do they push the tax down the supply chain?
The reality of the current market dictates that the 15% fee will be passed uniformly and entirely onto the Chinese buyers.
The compute deficit within China is acute, exacerbated by the global constraints on HBM3 availability.
The end users have zero negotiating leverage regarding pricing. They are strictly optimizing for allocation.
They will absorb the 15% premium and the underlying 25% tariff impact because the alternative is halting their AI development entirely.
If we connect this to the bigger picture, the secondary effects of these aggressive trade and export policies are rapidly reshaping the global technological landscape.
The intended effect was to stall the progression of foreign AI development by throttling their access to bleeding-edge compute.
The actual observable result is the explosive acceleration of China's domestic hardware and software ecosystems.
The friction of the U.S. supply chain has essentially guaranteed a captive, well-capitalized domestic market for Chinese hardware manufacturers.
Look at the public market reaction to More Threads, a domestic entity frequently positioned as a direct competitor to NVIDIA's architecture.
Their IPO on the Shanghai Exchange was a watershed moment. The equity surged 425% in its debut.
Raising 1.13 billion yuan. The domestic capital markets are aggressively underwriting the push for silicon sovereignty.
Funding the massive R&D required to close the lithography and architectural gaps.
And while the hardware catches up, the Chinese software ecosystem is executing a masterclass in architectural optimization.
Because Chinese developers do not have unfettered access to clusters of unconstrained Blackwell GPUs.
They're forced to innovate at the algorithmic level, writing highly efficient code that extracts maximum performance from inherently constrained hardware.
This constraint-driven engineering is yielding globally dominant results. Foundational models like DeepSeek V3.2, Minimax M2.5, and Moonshot's Kimi K2.5 are not merely competitive.
They are taking massive market share. When you analyze the telemetry for global API calls, which is the definitive metric for developer adoption and real-world utilization.
These Chinese models currently command 3 of the top 5 positions worldwide.
Their dominance in the API space is not a function of raw model size. It is a function of inference economics.
These models deliver latency and accuracy metrics that rival the premier Western models.
But because they have been optimized to run on less capital-intensive hardware, the cost per query is orders of magnitude lower.
For a developer building a high-volume application, the cost-to-performance ratio offered by a model like DeepSeek is economically undeniable.
By restricting access to the most efficient hardware, U.S. policy has inadvertently forced the development of the most efficient software.
We are witnessing the classic paradox of protectionist trade policy. The attempt to maintain hegemony by restricting supply invariably forces the adversary to construct a fully independent, parallel supply chain,
ultimately accelerating the exact outcome the policy was designed to prevent.
We have mapped an incredibly complex, multi-layered landscape today. We started by dissecting the macroeconomic constraints, analyzing how subtle shifts in the non-farm payrolls or the ISM services data can dramatically compress the valuation multiples of these tech giants.
And how understanding beta asymmetry between names like NVIDIA and Micron is critical for managing portfolio volatility.
We explored the brutal hardware arms race, detailing NVIDIA's entrenched CUD moat and aggressive Vera Rubin release cadence against AMD's MI350 hardware leap.
Their strategic utilization of Triton to commoditize the software layer, and their brilliant capital restructuring via the ZT Systems acquisition.
We tracked the vital supply of HBM memory from Micron, noting the extreme power efficiencies of the new SOCAMM M2 modules against the perpetual threat of cyclical oversupply.
Finally, we navigated the unprecedented friction of the new geopolitical reality, unpacking the stringent BIS licensing thresholds.
The logistical nightmare of the Trump administration's 15% revenue sharing mandate and the IAS KYC requirements.
And how these policies are directly fueling the massive IPO valuations of domestic Chinese hardware like More Threads and the global API dominance of optimized models like DeepSeek.
The variables are highly dynamic, and the tectonic plates of this industry are shifting under our feet.
This raises an important question. What stands out to you? When you look at the architecture of your own strategic investments or enterprise roadmaps, how are you weighing the inevitable transition from a market defined by brute force AI training to a market governed by the economics of AI inference? Are you factoring the massive cyclical volatility of the memory market into your timeline? And how are you hedging against the regulatory risks embedded in the current export controls?
You have to determine where the leverage truly lies in a market constrained by both physics and geopolitics. As you analyze the data flows over the coming weeks, I want to leave you with a macro-structural thought to consider. With the United States successfully weaponizing its IP through strict export limits and 15% revenue-sharing taxes, and China aggressively proving its capability to fund highly advanced domestic silicon like More Threads, while simultaneously capturing the global developer market with hyper-efficient models like DeepSeek.
Are we watching the permanent fracturing of the unified tech ecosystem?
Exactly. 5 years from now, will the very concept of a global computing standard be obsolete? If we are rapidly accelerating toward a reality with 2 completely bifurcated, incompatible technological stacks, one anchored in Silicon Valley and one anchored in Shenzhen, competing for global adoption, how does that alter the total addressable market? And ultimately, who actually captures the value in the AI race? Thank you for joining us on this exploration. Keep analyzing the tape, keep questioning the consensus, and keep diving deep. We will catch you next time.